Most of the time when people call me for an interest rate, they call me and I answer the phone and they say, "What's your rate?" And I'm assuming that they're asking for a rate on a 30-year fully amortized loan. And generally speaking, I am accurate and I am assuming correctly. But what I'm going to show you over the next couple of minutes here is a little kind of deep dive into the 30-year loan and what it actually looks like. So look, this is not about fear or hype. In fact, I love the 30-year fixed rate loan. There's a lot of positives to it, but there are some drawbacks to it. And I want to walk you through something most people, they never get explained clearly. And that's the 30-year mortgage. Look, it's familiar. It's what most of us grew up thinking was the smart move. But once you understand how it actually works, you might look at it a little bit differently. And you know, it's been around for 100 years, and it's survived through that period of time. But there's some truths that I want you to really understand about the 30-year fixed rate loan. In the early years of the 30-year mortgage, most of your payment goes to interest, not your home. Let's say that you have a $500,000 mortgage at 6.5%. So let's take a look at it. Let's go to my Vibe board and show you exactly what this is. So this is an amortization schedule. I'll make it bigger here. And so what you have is the 500,000 30-year loan at 6.5%. So that puts your payment at $3,160. And so we look at that, and the total of all those monthly payments equal $1.1 million or $637,000 of interest. And you can see that this is the amount of interest that you pay on this loan. It's a lot. It's more, obviously more than the loan amount that you got. But look at year one. Let's take a look at this a little bit bigger here. In year one, you're going to pay $32,000 in interest and about $5,500 in principal. Seem weird to you? It's a little bit weird to me. Year two, $31,000. Year three, we're going all the way down, and let's go to where you start paying more principal than interest. This is year 20, when you actually start paying more principal than interest for the year. And basically that's a break-even piece of it, right? It's not till year 23, 24, you start to pay. This is the time frame. The further down, the longer you go, that's when you pay all of your interest. So at the end of the day, that's not equity. It's not ownership. It's just the cost of borrowing. And it's not a knock on the mortgage. It's just how the amortization works. The bank, they're the ones that get paid first. They love this loan. In fact, do you ever wonder why when interest rates go down, how every bank is advertising, every mortgage company is advertising on the radio, digital advertising, wherever it's at, there's a ton of mortgage companies that are trying to get your business. That's because they get paid first. You start the process over. So you're 7, 8 years, 9 years in. Remember, the amortization schedule shows you that it's not till you're 20 that you start paying more principal than interest. Well, during first 7 years, you start over again. And it's just that constant starting over and paying more interest than principal. So even though you're lowering your payment, you're still possibly going to pay more interest. A lot of people refinance every few years and they think that they're going to save because that lower rate, that lower payment, it sounds like a win. But what you're also doing is resetting that clock. And that means back to paying mostly interest again. Do that a few times and you could be in that loan for 40 years without realizing it, 50 years. And it's time that you don't get back. If you carry that $500,000 loan for 30 years, you're paying, like I said, over $1.1 million to the bank. That's over $600,000 in interest. Now, I'm not saying mortgages are bad, but what I am saying is that we should be asking ourselves better questions. What else would you or could you do with that money? Where else could you go if your income wasn't tied up paying interest first? This is why I started to, using and move to the company that I'm at, CMG Home Loans, where they have the all-in-one loan. It doesn't change your income. It doesn't change how you spend. It just changes how your income interacts with your loan. So I have this loan and I've used it. I understand how it works. You earn your money, you deposit it. The deposit goes towards reducing your loan balance automatically. And I know this is not a video that explains the mechanics of it, but basically because the interest is calculated daily, that small shift, it adds up over time. You're still in control. So your money is still liquid, but now it's working harder for you by paying down your loan. This isn't about paying extra. It's not like putting in an extra $200 a month or $300 a month or rounding up your mortgage payment. It's about using what you already earn more efficiently. That's what made me pay attention, because the numbers, it made sense. It's not magic, it's just math. And I'm not saying that everyone should switch to this. I'm just saying this loan exists, and most people don't know that it does. If your earning is a lot and you're thinking long term and you don't love the idea of being in a 30-year payment cycle, this can be worth exploring. So if you're curious, just shoot me a message and we can look at your situation together, side by side, no pressure, because once you understand the numbers and how they really work, you'll make better decisions. Whether it's this path or the 30-year, it's up to you.